What's going on, everybody? And in this video, I wanted to do something a little bit different and kind of just talk about 2023 and how I plan on my investments, what I'm looking at. I'll even give you an insight of to the stocks I'm invested in and a few different things that I'm looking for in my investments for this coming year, just the way that I see things going. But if you do enjoy this type of content, all I ask is that you subscribe to the channel and you turn on post notifications so you don't miss out on any of my future content. But let's go ahead and kind of get straight into it. So I just wanted to mention, as you do know, the S&P 500 is doing pretty well. We do have CPI data coming up it's 7:19 p.m. So coming up in like literally 11 minutes, just because I am in Central Time. Over the past few days, the S&P is up 3%, but over the past year, we still are down 16%. So if you want to be making returns in this market, you've got to be investing your money very smartly and very wisely. So I kind of want to talk about stocks like Apple over the past year down pretty bad, Tesla down pretty bad, and this is why it could be a big year or a big few years coming for blue chip stocks. And I'm not saying just because stocks are down that means that they automatically have to come up. If you can find value for the right prices, just like Warren Buffett always says, that's whenever it's the best time to buy. So I just wanted to go over a few things. As we saw, this S&P 500 was down. All the top holdings, we got Apple, Microsoft, these big blue chips, which are all down pretty big amounts over the past year, which in a perfect world does mean they're going to be lower value than they used to be if everything is going well, if they're growing their earnings, they're growing their revenue, top and bottom line growth, and these are the things that you need to be looking for. So just to kind of give you an overview of what I like to look for in these companies is here's a few things. I just went to FinViz just because they throw out a ton of information. It's very easy to see. But a few of the things that I really like to look at, and you got to look at investor presentations and real annual income statements. I like to make DCF models as well. I get really into it whenever I do these investment researches. But the few key things that you need to keep in mind is the PE, the forward PE, and the PEG ratio. Is this company profitable or not? What do their earnings look like for the next year, the next few years? What do their sales look like historically, and what do they look like forward? And then their margins, how profitable is this company? Can they actually sustain their business and things like that? Those are just a few things I wanted to point out. But kind of just to show you everything, here's what I'm looking to invest in when it comes to like safe and long-term investments, So I look for companies that have or are like they have high barriers to entry, meaning that it's very hard for a new company to come in and kind of just dominate this market or take over this company. I look for a good margin of safety, meaning in my DCF models and things like this, I like to see that the upside potential is there and like to be pretty conservative on my DCF models to really make sure there is a margin of safety. I like to see fast and top bottom line growth, meaning fast revenue growth and fast net income and earnings growth, and then strong business forecasts, seeing that they have a higher potential in the future, they have good outlooks. And then I like to see that they provide value to shareholders in forms such as dividend growth and share buybacks. Those are two of the best ways to really provide value to shareholders. Share buybacks just meaning you own more of that company now because your ownership is worth a little bit more. And dividend growth, just that dividend income coming in and being able to reinvest your dividends and let that dividend snowball grow is incredibly powerful. I also like to see strong pricing power. So a company, for example, like Apple, everybody owns Apple products, and hypothetically, if Apple just continues to raise their iPhone prices, like people are still going to be buying the iPhone just because of how much they love it. That's strong pricing power. And then low execution and disruption risk, meaning management doesn't have to hit every single dot 100% perfectly for them to execute still well. And disruption risk, meaning, in a cyclical market, they're not going to be taken over by a recession and things like this. And the last thing I do like to see is lower debt on the company. I don't want to see a company that has all this debt and taking on all this risk. And because usually with high debt, it comes high execution risk. And those are two things that I don't want. And then I kind of want to talk about other investments that I'm making, which is going to be some low cost ETFs and some risky plays, like two stocks that I'm invested in right now that people would be calling risky that I've been invested in for a while. It'd be Neo or Upwork. The stocks are down incredibly bad, but I'm only investing in them when I'm ultimately willing to lose, so keep that in mind. But the mindset, I kind of want to bring this up, is the mindset that you need for investing is often like the most important part when it comes to this. And the first thing I want to mention is don't become emotionally attached to your investments and your portfolio in general. I mean in the sense that maybe a stock's down and you're like, oh, I love this company though, I don't want to sell. Or maybe you're just so emotionally attached to your portfolio that you're only happy on green days and you're sad on red days. Like, your life should not be like that. You need to not be emotionally attached to your portfolio at all. And then you need to accept being wrong at times and cutting losses. Like, maybe you did all this research and you felt so confident about a stock, but it didn't perform as you accepted and it's just continuing to fall. So it's okay to accept that, the best investors are wrong. Nobody's going to be 100% right. It's just the way the market is built. But then once you accept these losses and you cut the losses, make the necessary changes and invest that money elsewhere. Okay. Be patient. It's okay to wait for returns. Like, that's the best investors are patient. They like compounding. Be their leader per se. And then also lastly, don't have FOMO. You might see all this stuff of this, and that. Don't have FOMO. If you don't believe in something, don't invest in it. It's okay to not always follow the crowd. Just keep that in mind. But I did want to point out, as I said, I'll show you guys some of my investments. So I use M1 Finance for most of my stuff. I use M1 Finance when it comes to like more of my passive investing. I use TD Ameritrade when it comes more to my active investing. But just looking at this dividend portfolio, this is kind of my main thing. We'll just see like it composes of 6 different slices. That's one thing I really like about M1 Finance is how easy it is to automate your investments. If you don't have M1 Finance, I highly suggest you get it. Use the link down in the description below. I believe right now they're doing free $10 just for signing up for an account. Maybe you have to deposit some money, but still check it out. It's really good to use and you get that free money as well. It could be up to $50 also, but my slice for this dividend portfolio, my plan for this really is to invest in all these companies. Like, we'll look at my tech and cloud computing. I mean, it's down pretty bad recently because it's like Apple, Microsoft, all these companies that are doing pretty poorly over the past year. But just looking at this stuff, I plan on reinvesting these dividends, letting these companies grow their dividends, and just putting more money into the portfolio. And over time, and this is when patience comes into the equation. You got to be patient and let things slowly grow. And at some point in time, everything's going to be compounding and your dividend income will be absolutely incredible. So that is how I am planning to invest in 2023. I'll show you a little bit more into this portfolio before I close the video, but banking and fintech, we're looking pretty well. I mean, just kind of showing you what's all in this portfolio. And overall, my portfolio over the past year, it only goes back to May 18, 2022, because there are some stocks and things that have had some, inceptions and things like that. But since May 18th of 2022, we're up 4.69% overall. If we look at the S&P 500 since May 18th, let me pull up May 18th, the S&P is only up 0.93%. So we have provided some alpha with this portfolio, which I do really like to see. But everybody, that is going to wrap it up for this video. So if you did enjoy it, make sure to subscribe to the channel and go ahead and check out M1 Finance using the link in the description down below to get some free money as well. Thank you for making it to the end of this one. I hope you enjoyed it. Leave down any comments down below you might have for tips in investing in 2023. And I will see you at the next video.